Welcome to the 11th lesson of Chapter 6, where we delve into the details of a trading scenario with a single margin threshold. Now you might be wondering, what is a single margin threshold? It's a unique trading situation where the margin call level is set at 100%. In layman's terms, it's a high-stakes game where the broker requires you to have all the required margin in your account. Let's break it down for a moment. In the world of Forex trading, the margin is the minimum amount of money required in your account to open a trade. Now, imagine a scenario where your broker sets the margin call level at 100%. This means that if your margin level drops to this threshold, you're in for a margin call. The broker may close your positions and the risks are, quite frankly, escalated. But why would anyone trade under such conditions, you ask? Well, it's a bit like walking a tightrope. It's risky, yes, but it also comes with the potential for high rewards. It's a scenario that demands strategic planning, careful decision-making, and a keen understanding of the market dynamics. In this lesson, we'll explore the implications of having a broker with a margin call level set at 100%. We'll talk about how your initial deposit plays a vital role in determining your leverage potential, and why cautious risk management becomes more critical than ever in this scenario. We'll also take you through a step-by-step breakdown of how margin is calculated and its impact on your trading decisions. We'll even walk you through a practical trading scenario to help you understand how the dynamics unfold under the constraint of a single margin threshold. The world of Forex trading is complex, and the stakes are high when the margin call level is at 100%. But with a solid understanding of the risks and a strategic approach to managing your margin, you can navigate this high-stakes scenario successfully. Let's keep in mind, when the margin call level is at 100%, the stakes are high, and strategic planning becomes crucial. A key determinant of your leverage potential is your initial deposit. The world of Forex trading can be an exhilarating ride, but it's not one to be taken lightly. Your initial deposit, the first sum of money you invest in your trading account, plays a crucial role in shaping your trading journey. Think of your initial deposit as the foundation of a building. The stronger and more substantial it is, the higher you can potentially build. But there's a catch. A larger deposit doesn't necessarily equate to larger profits. Instead, it amplifies both your potential gains and potential losses, and making the ride all the more thrilling or terrifying. This is where risk management comes into play, like a safety harness on a roller coaster. It's your strategy to mitigate potential losses and keep your account afloat, especially when trading with a broker that has a margin call level set at 100%. At this level, if your margin falls to 100%, you're in the danger zone. Your broker will issue a margin call, warning you that you need to deposit more funds or close some positions to prevent further losses. If you fail to do so, your broker may start closing your positions, starting with the most unprofitable ones. Now, doesn't that sound like a situation you'd want to avoid? That's why it's vital to practice cautious risk management. One way to do this is by not over-leveraging your account. While it can be tempting to use high leverage to amplify your profits, remember that it also amplifies your losses. Another crucial aspect of risk management is to diversify your trades. Don't put all your eggs in one basket. Spread your trades across different currency pairs and markets. This way, a loss in one trade won't wipe out your entire account. Lastly, stay informed. Keep a close eye on market trends, economic news, and other factors that can affect the Forex market. Use this information to make informed trading decisions and adjust your risk management strategy as needed. To sum up, your initial deposit determines your leverage potential, but it's not a ticket to guaranteed profits. With a margin call level set at 100%, the risk is even higher. Hence, it's crucial to practice cautious risk management. Don't over-leverage your account, diversify your trades, and stay informed. Remember, a larger deposit doesn't necessarily mean larger profits. It's all about sensible risk management. It's not about how much you invest, but how wisely you manage your risks. So strap on your safety harness, stay alert, and enjoy the ride. Understanding how margin is calculated is fundamental to making informed trading decisions. Dive into the depths of margin calculations and their impact on our trading journey, especially when we are working with a broker who sets the margin call level at a flat 100%. This scenario presents unique challenges and requires a keen understanding of the mechanics involved. Let's start with the basics. What is margin? Margin is the amount of capital required by your broker to open a position. It's not a fee or a transaction cost, but rather a portion of your account equity set aside and allocated as a margin deposit. Now, how is it calculated? A simple formula is used. Margin equals position size divided by leverage. For instance, if you want to open a position of 1 lot or 100,000 units, and your broker offers a leverage of 50 to 1, your required margin would be 2,000 units of the currency you're trading in. But what happens when the margin call level is set at 100%? This means that if your margin level, which is your equity divided by used margin, falls to 100%, you'll receive a margin call. The broker will ask you to deposit more funds into your account or close some positions to free up margin. If you fail to do so, your broker may start closing your positions to secure its own risk. So, how does this affect your trading decisions? Imagine you have a balance of 10,000 units and you decide to open a position worth 5,000 units. Your margin level at this point is 200%. But let's say the market moves against you and you lose 4,000 units. Your balance is now 6,000 units, which brings your margin level to 120%. You're dangerously close to the 100% margin call level. In this situation, you have 3 options: deposit more funds into your account, close some positions to free up margin, or do nothing and risk your broker closing your positions if your margin level drops to 100%. Each option has its own set of implications. Depositing more funds can increase your equity and margin level, giving you more room to maneuver. Closing positions can also free up margin, reducing your exposure to the market. However, both these options require careful consideration and strategic planning. If you do nothing and your margin level falls to 100%, you'll be in a margin call situation where your broker may close your positions, and you could lose your entire investment. Trading with a broker that implements a single margin threshold at 100% places a heightened emphasis on risk management and strategic decision-making. It's not just about understanding how margin is calculated and how it affects your trading decisions. It's also about knowing your risk tolerance, managing your positions wisely, and being prepared for market volatility. The bottom line? Margin trading can be a powerful tool in the Forex market, but it comes with its own set of risks. When the margin call level is set at 100%, the stakes are even higher. Keep in mind, when the margin call level is at 100%, a well-calculated move can mean the difference between profit and loss. Scene script. Let's now examine a practical scenario to better understand how trading dynamics unfold with a single margin threshold. Picture this. You're a trader who's just opened a position with a broker that implements a single margin threshold. The margin call level is set at 100%. You've made your initial deposit, carefully calculated your leverage potential, and you're ready to dive into the market. As the trading day unfolds, the market starts to move against your position. You see your margin level creeping closer and closer to that 100% threshold. You're experiencing firsthand the heightened risk that comes with this kind of trading environment. It's a high-stakes game, and the pressure is mounting. Now, in this scenario, the decisions you make next are crucial. Do you close out your position to prevent a margin call, or do you add more funds to your account to maintain your position in the market? Each option presents its own set of challenges and risks. If you choose to close your position, you'll be cutting your losses. But what if the market shifts in your favor shortly after you close out? You would miss out on potential gains. This is where strategic planning and understanding market trends become essential. You need to be able to anticipate market movements to make informed decisions. On the other hand, if you decide to add more funds to your account, you're taking on additional risk. If the market continues to move against your position, you could end up losing more than you initially invested. This is where prudent risk management comes into play. You need to be prepared for all possible outcomes and manage your risk accordingly. This scenario isn't just about making quick decisions under pressure. It's about understanding the implications of those decisions. It's about recognizing the risks associated with a single margin threshold and learning how to navigate them effectively. In the world of Forex trading, knowledge is power. The more you understand about how margin works and how it impacts your trading decisions, the better equipped you'll be to handle the challenges that come your way. And when faced with a 100% margin call level, that knowledge becomes even more critical. So, as you delve into your trading journey, remember this scenario. Remember the heightened risks and the importance of strategic planning and risk management. Remember that every decision you make can have significant impacts on your trading outcomes. This scenario illustrates the importance of strategic planning and swift decision-making in trading with a single margin threshold. Remember that in the world of Forex trading, The ability to adapt and make informed decisions is what sets successful traders apart. Understanding and responding to margin requirements is critical to prevent rapid liquidation of positions. In the fast-paced world of Forex trading, it's easy to get caught up in the thrill of potential profits. However, it's equally important to understand the risks involved, especially when your broker implements a single margin threshold, specifically a margin call level at 100%. A margin call at 100% means that if your margin level drops to this threshold, you are at risk of having your positions liquidated rapidly. This is not a situation you want to find yourself in, as it could lead to significant losses. How does this work? Well, let's say you have an open position and your margin level drops to 100%. This means that your equity equals your used margin. In other words, you have no available margin left. At this point, your broker will issue a margin call, requesting that you deposit additional funds into your account to maintain your open positions. If you're unable to meet this margin requirement, your broker has the right to close some or all of your open positions to cover the margin deficit. This is known as liquidation, and it's not a gradual process. It can happen rapidly, leaving you little time to react or make strategic decisions. This is why understanding the consequences of a margin call at 100% is so critical. Knowing the risks involved can help you make informed trading decisions. It can encourage you to be more cautious in your trading strategy, perhaps by using less leverage or by setting stop losses to limit potential losses. Having a clear understanding of the consequences also emphasizes the importance of effective risk management. It underlines the need for careful monitoring of your margin level and proactive response to margin calls to protect your investment. In conclusion, the world of Forex trading offers great potential for profit, but it also carries significant risks. One of these risks is the possibility of rapid liquidation of positions if you do not meet your broker's margin requirements. Forewarned is forearmed. Knowing the consequences of a margin call at 100% can save your investments from rapid liquidation. We've now come to the end of this enlightening journey into the world of trading with a single margin threshold. We've learned that working with a broker who implements a 100% margin call level can heighten risk, making strategic planning and careful margin management absolutely essential. We delved into the significance of initial deposits and how they influence leverage potential. We also discussed the need for cautious risk management to prevent swift margin calls. We broke down the calculation of margins and how they can significantly impact trading decisions. We also walked through a practical scenario demonstrating the harsh realities of trading dynamics with a single margin threshold. In all, we highlighted the critical importance of understanding and responding to margin requirements to prevent rapid liquidation of positions. Remember, understanding is the first step towards proficiency. On that note, it's time to move on to the next lesson, navigating a trade with defined margin call and stop out levels. See you there.